Imagine this for a moment. You are a complete beginner. You hear people talking about stocks, profits, crashes, and opportunities. But deep inside you feel confused and a little scared. You keep asking yourself, what if I lose my money? Today's video is built exactly for that fear. In this case study, you will follow a real beginner-style journey in the US stock market. You will see how a normal person started investing step by step, what mistakes were avoided, what decisions actually mattered, and how you can apply the same approach without stress or guesswork. If you stay until the end, you will clearly understand what a beginner should buy, how much money is enough to start, and how to survive market ups and downs without panic. Let's talk about Alex. Alex is 25 years old, lives in the United States, and has no finance background. He is not rich, not a trader, and not chasing quick money. He simply saves about $300 a month and wants his money to grow over time. Like most beginners, Alex had one big question before starting. Am I even ready for the stock market? Instead of rushing in, he decided to start with the right mindset. He made a simple decision that changed everything. He told himself that the stock market is not gambling. It is not a get-rich-quick system, and it is not about daily excitement. He committed to becoming a long-term investor. He asked himself one honest question. Can I stay invested for 5 years without touching this money? That mindset alone protected him from most beginner mistakes. When it came to money, Alex did not start big. This is where many beginners go wrong. They think more money means more profit, but it also means more fear. Alex chose to invest only $200 per month. This amount was small enough that he would not panic if the market went down, but real enough that he would take learning seriously. He understood a simple rule: never invest money that will affect your sleep. For beginners, small money is not a weakness, it is cheap education. Every small mistake becomes a lesson instead of a disaster. Before buying anything, Alex opened a US brokerage account and made another smart decision. He did not buy individual stocks on day one. Instead, his very first investment was an S&P 500 ETF. This single investment gave him exposure to 500 of the biggest and strongest companies in the United States, including Apple, Microsoft, Amazon, and many others. His logic was simple. He was not trying to beat the market. He just wanted to grow with the market. For beginners, ETFs work like a safety belt. They reduce risk, remove pressure, and help you stay invested longer. A few months later, something important happened. The market dropped. Headlines were negative. Social media was full of fear, and many beginners were selling. Alex opened his account and saw his investment was down. His $600 had dropped to around $530. This was the real emotional test. 90% of beginners panic at this stage. Alex felt nervous too, but he did not sell. He reminded himself why he started. Instead of stopping, he continued investing the same amount every month. He realized that market drops are not disasters for long-term investors. They are discounts. This one decision taught him emotional control, which is more valuable than any stock tip. After about 6 months, Alex felt more confident. He understood how the market moves, how ETFs work, and how emotions can ruin decisions. Only then did he add individual stocks, and even that was limited. He kept about 80% of his money in ETFs and used only 20% for individual companies. He chose strong, profitable, well-known businesses with long-term potential like Apple, Microsoft, and Nvidia. He avoided hype stocks, meme stocks, and social media tips. Every stock he bought had a clear reason behind it. His rule was simple. If he could not hold the stock for years, he would not buy it at all. After 1 full year, Alex reviewed his results. He had invested around $3,000 in total. His portfolio value was roughly $3,450. The profit was not life-changing, and he did not become a millionaire. But something far more important happened. He built the habit of investing. He removed fear. Market drops no longer scared him. Instead, he saw them as opportunities. He became comfortable with patience, consistency, and long-term thinking. That is what real success looks like for a beginner. Many beginners fail not because the market is bad, but because their behavior is bad. They put all their money into one stock, check charts every hour, follow random tips online, and panic sell during drops. Alex avoided these traps. That is why he stayed in the market while others quit. The goal for beginners is not to make fast money. The goal is to survive, learn, and stay invested long enough for compounding to work. If you are just starting out, your mission is simple. Start small, stay consistent. Focus on strong, diversified investments. Control your emotions. You do not need perfect timing or secret strategies. You need patience and discipline, if you want. The next video can break down beginner portfolios for $100, $500, and $1,000 step by step. Let me know in the comments where you are watching from and what your biggest fear about stock investing is.